right, we've made it to episode 3 in our series for architecting Bitcoin credit markets. Now, as a recap, in episode 1, we kind of set the stage for Bitcoin-backed credit as a whole. We described simple ideas like posting Bitcoin as collateral and borrowing dollars against it. And then we foreshadowed these ideas of financial plumbing, which is usually how lenders reuse and recycle capital to really scale credit markets. In episode 2, we talked about the state of DeFi. We looked in the past how people have tried to recreate borrowing and lending or credit markets on a blockchain. And we did this by looking at 3 different models. The first was ETHLend, which tried to use an order book to match borrowers and lenders on chain. This allowed people to really do kind of granular and bespoke loans, like fixed interest rate loans. But there were a whole bunch of other issues that we're actually going to go into in this whiteboard. Then we talked about Aave, which kind of really popularized the pool-based lending model. The real kind of innovation here is what we call permissionless capital formation. This idea that lenders could just deposit capital like stable coins into a smart contract. They could set it and forget it, and then it can earn yield for them. That idea was very successful at bootstrapping capital. The trade-off with pool-based models is you can't really have very bespoke loans. Like everything has to be a variable interest rate loan, for example. We then talked about Morpho V1 in particular, which also was a pool-based model like Aave. The difference is that it's a bit more modular, where anyone can go and create their own pool, and then they can kind of compete amongst each other. So as opposed to Aave, which is more monolithic, one entity, Morpho kind of allows many different entities to compete. Okay, so that brings us to this 3rd episode, where we're going to talk about a new DeFi architecture that's coming out, which is actually Morpho V2. And Morpho V2 will reintroduce Orderbooks into kind of their existing infrastructure. And that allows things like fixed maturity loans. So what we'll do is we're going to walk through an example to recap how Morpho V1 works. And then we'll kind of show the new components that Morpho V2 added. And then you kind of have a whole idea of the architecture. So let's go ahead and get into it. As a reminder, we kind of have LPs up here. These are entities, let's just say that they have dollars or stable coins. Okay. And in Morpho V1, you have these different, what we call vaults here that can be set up by curators, where they're essentially competing for these deposits. They're saying here, put your money in here or here, or here. And we can call this, vault A, B, and C. Okay. And so again, these are called vaults. And these are created by these entities called curators. Okay. And in Morpho V1, these compete on, in my opinion, like relatively simple metrics, basically like what collateral or what LTVs they're willing to lend dollars at. So Vault A may say, hey, we're only willing to lend your dollars against, Bitcoin as collateral. Maybe Vault B says, hey, we'll lend it against Ethereum and Bitcoin. And maybe Vault C says, hey, we're just going, degen, we'll lend it against any collateral because we're going to try to maximize the yields. But these kind of vaults are basically competing for dollars. So then we can keep playing out the example. We could say Vault A is going to put their money, again, into a market over here. And the market has certain terms where it says it's Bitcoin as collateral. And because it's Morpho V1, we're going to say it's variable interest rate. And then you have the borrowers down here. Okay. And maybe they hold Bitcoin as collateral and they say, great, I want to post my collateral here and borrow against it. So again, these are called markets over here. And so in Morpho V1, as a reminder, when you have somebody that's willing to lend dollars and then somebody that's willing to post collateral, the market is made, and the way that the interest rate is determined in Morpho V1 is something that we call the utilization curve, right? So this is kind of a staple of pool-based lending. You have a utilization curve that looks something like this. And what this is basically saying is that there's a certain amount of liquidity that exists in this vault. Some of it is sitting there just kind of liquid, and some of it has already been loaned out. And so at any given time, if say 75% of the liquidity has been loaned out, maybe that corresponds to, this point right here on the curve. And that means it's maybe like 4% variable interest rate that all borrowers are being charged. If more people start borrowing and the utilization goes up, you'd have a new line maybe that goes like over here. And that corresponds maybe to like, I don't know, a 7% interest rate. I'm kind of just making numbers up. Okay. And then, so this interest rate, again, it's a floating interest rate that applies to all borrowers. Doesn't matter if you borrowed when it started at 4%. If it's today, it's 7%, then every single person pays that. Okay. So this model has been pretty successful in DeFi, and it's kind of like the foundation of how most DeFi exists currently today for borrowing and lending. But a lot of people want kind of bespoke terms, right? They want things like fixed maturity loans where they say, I'm locking in, a 6% loan and I know that I'll have that for 12 months. So if we played out that example, we can just add another market here and we could say, okay, great. You could put BTC as collateral and maybe you want a 1-year loan term. Okay. And the way we know how to do this is just with an order book, right? We create an order book that doesn't have this utilization curve where people can just agree to their own terms. And so that looks something like this, Okay. So we have the order book. And what this is kind of just indicating, right? It's like the midpoint is maybe the most recent loan that's been originated. Maybe it was at 7%. And as you go to the right, if interest rate increased, the order book basically says, hey, we have a lot more liquidity we're willing to lend if you're willing to pay a higher interest rate. If you go left and you say the interest rate goes down, then the borrowers are saying, look, we have a lot more collateral we're willing to post to borrow dollars against it. Okay. So order books allow us to get these bespoke terms that people want. Okay. So we can kind of put a check mark here and say, if we reintroduce order books, we can kind of get this advantage. But if you recall from the last episode, there were a slew of issues of reasons why order books didn't actually work. And so we'll go through these and kind of explain what the change is in Morpho V2. The first thing is that an order book, it's constantly changing, right? There's lenders are adding liquidity, they're moving liquidity, they're modifying their orders. And so if that exists on a blockchain, then you're having to pay gas fees and then you have to wait for block times and it doesn't really work. It's inefficient. So what Morpho actually says is, look, let's just move the order book off chain. So I don't even know how I would draw it, but yeah, just imagine like this order book here exists off chain. And then if a match is made, if a borrower and a lender say, great, we agree on this price and this terms, then it moves onto the blockchain and settles on there. So you have this hybrid approach where the order book exists off chain. So you don't have to pay gas fees and worry about, block times and all that. Only when a deal is made does it move onto a blockchain. Okay. So that's how they handle that. The second thing is, in this same vein, order books typically require active management, right? Like if you're a passive, just kind of normal, non-sophisticated retail lender like myself, and I put an order, I say, I'm willing to lend $10,000 at 10%. It's like, well, somebody may not pick up that order. Like a borrower may say, that's way too expensive. And so then I would have to like move the order and be like, well, okay, maybe I need to increase my lending size. Maybe I need to drop the interest rate. Like there's constant active management that has to happen. And that the order book, like we talked about, is constantly moving. And so that was a huge pitfall in ETHLend, is that the market just wasn't sophisticated enough, and retail LPs are just not in a position to like be active managers, right? And that's why pool-based lending, like this first model we described, was so wildly successful. It's like lenders could just put their money in, the utilization curve determines the interest rate, everybody earns, it's set it and forget it, and you're good to go. Morpho actually has a solution for this. And I don't know if they meant to do this. They've been thinking about this for years, or it was just like by happenstance, but they already have the actors that could be active managers, to quote order books. And it's these curators, right? And so these curators were originally designed almost as risk managers, where they say, look, we're going to compete for your deposits by just saying we're only going to lend in against Bitcoin or Ethereum or whatnot. But they're also like typically like very specialized, like they understand these lending markets well. So they can now actually play the role of the active manager. So a curator could actually actively quote this order book, and the lenders or the LPs can still be passive. So they just put their money into a vault, and then they kind of entrust that responsibility to them to quote the order book and get the best price. And because it's a permissionless open market, you could have many different curators that are all kind of competing for that top spot. So really, Morpho V1 slots in perfectly into the need for having active managers with order books. Okay. So the next thing that we want to consider is, like, if you start adding order books, you have many different order books for different types of loans that you want to do. And like, how can you ensure that all of these order books actually have liquidity depth? So let's draw this out. We're going to add another order book here. Maybe we're just going to say that there is some borrower that's institutional that says, I need, fixed interest rate loans for a year, and I need to ensure that the dollars are KYC'd because my compliance needs to ensure that it's not from North Korea or something, right? So you can create another order book right here. where we say Bitcoin is the collateral, the loan term is 1 year, and any dollars that are being borrowed from here have to essentially be KYC'd, okay? We have our little order book drawing right here, okay? All right, but if you add, say, dozens of these different order books and types, some for 1 month loan or 3 month loans or 9 month loans and all sorts of different parameters, then how can you ensure that all of these have the depth where a borrower can look at that book and say, oh, there's millions of dollars or, $1 billion that I could borrow from. It's not like some scattered thing where, they can only borrow $10,000 at like a 20% interest rate, right? And so the way that Morpho V2 solves this is something called intent-based liquidity, where a curator can say, look, I'm just going to write one single intent that can essentially apply an offer across many different order books. So they could say, I have $1 million right here that they're willing to lend for 1 year, whether the dollars are KYC'd or not, into that order book. And then also they're saying, I can submit that same offer into this order book because I am willing to essentially KYC my dollars. And so now you have one order for maybe $1 million that can spread across 2 different order books simultaneously, okay? And to be clear, as soon as somebody accepts those dollars and it's taken off the order book, then it's taken off of both. But until that happens, it can serve as depth in the order book simultaneously across multiple order books, okay? And so you could have, you'd have this entity C that says, look, I'm willing to submit an order here and here. And then even if we added like another order book, of some other criteria, they could also submit liquidity here. So these curators could write one intent that can serve a dozen different order books. And so that prevents this big fragmentation of liquidity and offers. Okay. So we have this thing called intent-based liquidity. Next, let's talk about a concept of called zero coupon bonds. So in ETHLend, one of the problems that we described is that every loan that was made was kind of like a special snowflake, or it was non-fungible. So if I originate a loan at 5% to Alice backed against Bitcoin, and then I originate another loan to Bob at 5.1% or even, also 5%, these are treated as 2 separate loans. Like you can't really aggregate these loans. They're not, the underlying units are not fungible. And so that becomes a little bit of a management nightmare for the protocol and the lender. And so what Morpho V2 uses is a concept called zero coupon bonds, which abstracts away the notion of interest. And so this is actually how US Treasuries work, where if you loan the US government $100, they're not actually borrowing those dollars and then paying you an interest rate. Instead, they're saying, look, I will sell you a $100 bond that you can redeem a year from today, but I will sell it to you at $95 today. So it's more like you're buying a future bond at a discount rather than earning interest, okay? And so I'll explain why that matters here in this concept of zero coupon bonds. So let's just say that in an order book, somebody agrees, 2 parties agree to say, look, we're going to do a loan at, 5% fixed interest rate for a year, okay? So let's just say this is like a 5% loan. And let's say there is, a lender down here, okay? The borrower is over here. And this is the protocol, okay? And so when this loan is initiated, the lender will, of course, send the dollars up to the borrower. The borrower will send their BTC as collateral to the protocol, and the protocol will actually mint these units that we're calling zero coupon bond units, and they will send these down here. And so if we agree on 5%, then the lender will have sent approximately $95 to the borrower, and the protocol mints 100 of these units. And so what's effectively happening here is the lender is effectively buying 100 units from the protocol for $95, okay? And these 100 units are redeemable for $1 of a stable coin in a year from now. And so because they bought this at the discount of $95 and they got 100 units, implied in that is some sort of interest rate. Okay, so this will make more sense when I give a second example where if somebody originates a loan for 4%, right? And let's say we have the lender over here, we have the borrower, okay, and you have the protocol. So borrower sends BTC, protocol sends these units to the lender. Lender sends, in this case, let's say $96, approximately $96. And implied in that is a 4%, interest rate that they would earn. And the protocol sends 100 of these units here. Okay. So now, even though these were two separate loans, and this one was an implied interest rate of 5%, and this one is an implied interest of 4%, these units are essentially fungible. Because at the end of the day, it's like at some certain date in the future, these share the same maturity of 1 year. These units are redeemable for $1. It doesn't matter what the lender paid for them. The units themselves are the same. Okay. So now within a certain order book, all the units are fungible. That is like a pretty nice, quality of life and efficiency breakthrough for the lending and the protocol. Okay. So now we have the zero coupon bonds, which reduces the kind of non-fungibility issue of the loans. This architecture right here, in my opinion, is quite beautiful. And as far as I know, not much else exists like this in existing DeFi. And to recap, it's like we get these bespoke terms, so we can do things like fixed maturity loans, fixed interest rate loans. You can add parameters like, hey, this order book needs to be KYC dollars. You could add parameters like, hey, in this order book, there's going to be a permission liquidator because the compliance requirements of that. You could do things like margin calls and delayed liquidations. Like you can have very, very bespoke, customized loan terms, as opposed to just the, hey, you get a variable interest rate loan. That's just the way it goes. The order book is again off-chain, so we don't have to pay gas fees. We have this kind of nice balance between lenders here can be passive LPs. The curators kind of handle all the active management of order books. This intent-based liquidity here allows us to have liquidity that spreads across all order books, so you have huge amounts of depth. The zero coupon bonds reduce the fungibility issues. The last thing that I want to mention here, and this is kind of hinting at our next episode, is when LPs put money into these vaults, they need to receive some sort of receipt representing their position. This is basically a token, right? I put in, $1 million into a vault, and I receive back, an IOU basically from the C vault here that says, your dollars are backed by, all the different loans that we've made here, right? So I'm gonna kind of pop this out here and say this is basically an IOU, right? So the curator kind of returns some sort of IOU to the LPs representing their position. And this IOU, in many ways, I'm going to call it kind of like a Bitcoin CLO. It's like a Bitcoin CLO, or like a Bitcoin collateralized loan obligation. And some of you may hear that term and you're like, oh my God, this sounds like the plot of, Big Short or Margin Call. But collateralized loan obligations are actually like very powerful forms of collateral. But the risk of them is like, you don't really know what's backing them always. Like it's hard to kind of audit and fully see, the quality of collateral underlying it. But if you have this, now it's like you could hold a share of a kind of Bitcoin CLO and you can provably verify on chain like all of its backing. You could say, oh, this C vault is backed by 50% variable interest rate loans. I know all of the loan to values and how many borrowers are backing that. And maybe the other half is in these kind of, fixed maturity 1 year Bitcoin loans. You could see if any of those are in default. And basically every single thing is verifiable. And so now we talk a lot about Bitcoin being pristine collateral, which it is, to be clear, but it's also volatile. And for some people, that's a detriment in its collateral. So if you have a dollar denominated, Bitcoin backed loan obligation, it kind of functions almost like a Bitcoin backed stable coin. And this itself could become the predominant collateral of the entire on-chain credit system. And so that I think is very exciting. And that's what we're going to cover in the next episode, chapter 4. So here it's like, this just appeals to anybody that wants to borrow against their Bitcoin at whatever terms they want. And then this is where some financial engineering can happen, and you can get a lot of benefits of driving a lot more liquidity to this. So, yeah, that is episode 3. All right, so tune in next time for episode 4. We're going to cover a bit about secondary markets and securitization and these Bitcoin CLOs. All right, thanks.